Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This is episode number 83. And this week on the podcast, I want to talk a little bit about equity compensation. A lot of people around the country are paid in some form of company shares, whether it be restricted stock units, incentive stock options, non-qualified stock options. Others have access to an employee stock purchase plan that they might use, and it results in a couple of problems long term. One is that you tend to get over-concentrated in your own company's shares, and two, it creates a bit of a tax problem long term, because if you want to trade out of those shares, it just results in a big tax burden. So this week on the podcast, I wanted to cover a strategy that you might want to consider if you're someone who is compensated in company stock. I hope you enjoy it. Hey everybody, real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. Alrighty. This week on the podcast, I want to talk about a strategy that makes a lot of sense for anyone who's compensated in with some form of equity. And there are a lot of people around the country these days that work at public or also private businesses, privately held businesses, who receive some form of equity compensation as part of their overall comp system. And that can come in the form of restricted stock units, RSUs. There's a lot of companies have employee stock purchase plans, publicly traded companies. A lot of people receive incentive stock options and non-qualified stock options. And I believe in the past on the podcast, we've talked a little bit about the taxation of incentive stock options and non-qualified stock options and how that really fits into your bigger financial picture. But in general, for what we've run into more recently, but for a lot of years here at the financial planning firm, is people who receive this kind of equity compensation have a couple of issues that they're constantly struggling with. Number one, the portion of your net worth that's tied up in the company you work for becomes exorbitantly large, and that presents a lot of risk. And I'm not going to sit here and pound the table today for diversifying out of your own or the company where you work's shares. If you're someone who has a lot of stock in the company where you work, be it Amazon, Facebook, Google, Apple, any of the main tech companies, any publicly traded tech company, actually, they're very good at compensating their employees with some form of shares. And so, that aside, a lot of people end up with a lot of their net worth tied up in their own company. And even if they wanted to diversify out of it, it becomes kind of a tax issue when you've worked somewhere for a while and the value of the shares that you own has grown, and selling them or trading out of that position in any way, shape, or form would come attached to a big fat tax bill. That's undesirable. The second thing that comes up, whether you deal with it in that manner or not, is the tax implications long term. Because even if you decide that you're not over concentrated today, and you make the decision to trade out of that over-concentrated position 5, 10, 15, 20 years down the road, it's a tax problem at some point, and that becomes a huge liability long-term. So now, as I'm talking through that, those are two different items that are really one and the same, I guess. But you'll have to bear with me here because this is a little bit of an unstructured monologue. Anyway, there is a specific way that I like to think about handling this that really makes a lot of sense for people who are in this situation. And it's a little bit aggressive, but it just makes a lot of logical sense when you have all these options and programs at your fingertips. And so on today's podcast, what I'm going to do is cover each of these programs in an explanatory way, and then tie them all together into the specific strategy that seems to make sense for people who are compensated by a lot of options and restricted shares and equity in the company where they work. Now, again, I'm not going to beat the table for reducing concentrated positions in your company shares too much. If you're working somewhere and you really believe in the mission of the company and you believe it's going to go on and do great things and grow in value and be the best place for your dollars, it can create a whole lot of wealth for you, and that's great. And that's true of publicly traded corporations. It's true of private companies that may go public at some point in the future. But I'll also say that there are so many horror stories out there of people who are still in a very, very bad place financially because they were they worked at like Enron and invested their 401k dollars in the company shares, in addition to having some of these equity compensation mechanisms. WorldCom, I mean, there are dozens of examples of these companies that seemingly were on very sound footing. Meanwhile, under the surface, unbeknownst to nearly all of the employees who really had a lot of knowledge about what was going on at the company, they were on tenuous footing and eventually went belly up. And so the concentration in the equity in the company where you work can create a lot of wealth, but it's also a pretty dangerous proposition. That's a conversation for another day. Let's start today by going through each of these different programs one by one, just to explain what they all are. The first that I'll explain is an RSU program. RSU standing for Restricted Stock Units. A lot of companies have these and will grant their employees shares of the company on based on a vesting schedule and based on their own performance. So maybe as part of your annual bonus, you might get some of your bonus in cash. You might get some of your bonus in restricted shares as a grant. Typically, the way this works is when you receive shares, whether it be based on your own performance or whether it be company-wide or whatever it is, whenever you receive restricted stock units, they vest over time. So if you receive 100 shares of stock that vests semi-annually over a 4-year cycle, what that means is that every 6 months, 12 and a half shares of those 100 are going to vest. And even though you have the rights to 100 shares, if you leave the company, any unvested shares disappear. And so it's a nice way for really any company, but particularly tech and publicly traded companies these days, to retain the employees that they like. They give them performance bonuses that are tied up in unvested shares. When you have a lot of unvested shares on the table, it makes you less likely to leave because you're walking away from a lot of money. From a tax perspective, these shares are not taxable to you until they vest. When they do, the value of the shares at vesting is considered W-2 income. So if you have 100 shares that vest this year and the shares are trading at $50 a share, that means that whether you like it or not, you're going to have 50 times 100 or $5,000 of extra income. And you could, of course, sell some of those shares after they vest to raise cash to pay the tax. You could hang on to the shares. There's, any number of things that you can do with it. But it's a really nice mechanism for companies to retain talented employees that they want to keep around. And it's also a nice feature for employees, just as a token of appreciation. The downside from the employee's perspective is that it's income to you whether you like it or not. And there's really no way in almost all of these plans. I believe it's possible to create or to give a plan the option to have an 83B election and pay tax before the shares actually vest, but that option is few and far between in restricted stock unit plans. At any rate, that's restricted stock units. And it's a really common feature in, again, publicly traded and private corporations these days. The second program that I'll mention are employee stock purchase plans. These are they're very rare. I don't even know that I've ever seen one in a private company, but in a publicly traded company, it's really common to have. And basically, you have the opportunity to defer money out of your paycheck that accumulates in this account that you don't see. And every 6 months, typically it's every 6 months, the money that accumulates in that account out of your payroll deferrals is used to purchase shares in the company at a discount. And this is allowed by the IRS to, I don't know specifically why they allow it, but it's a nice tax advantaged opportunity for you to buy shares of your company at a discount. Some programs will look at the 6-month time interval over which your deferrals are accumulating, and over that 6 months, they'll look at the closing price of the shares every single trading day, and then choose the lowest closing price over that 6-month accumulation period, and then give you a 10% discount off of that. That's really the best case scenario. Sometimes other programs will use the average daily close, but the most beneficial to employees is the one with the best discount. The way that this is taxed is when the cash from your payroll deferrals is used to purchase shares. The amount of the discount, so that 10%, hypothetically, is considered W-2 income. Anything after that is considered a capital gain. So if you have a 6-month period where you defer $10,000 from your paycheck into this plan, let's say that the market price on the day that the shares are purchased is $100 a share. Well, you're going to, if you get a 10% discount, you're going to get shares purchased at let me back up. Let's say that they're trading at $110 a share on the day that the shares are purchased, but the low point over that 6-month period is $100 a share. You're going to get 10% a 10% discount off of that $100 share low, or be able to purchase shares for $90 each. Well, that difference between $90 and $100, the discount off of the low over the 6-month time period, is W-2 income. So $10 times however many shares you wind up purchasing. If you then sold the shares immediately, that $10 difference between the $100 a share, the low, and the $110 that is trading for at the time, is a short-term capital gain. So you can, a lot of people will participate in these programs, take advantage of that discount, and then sell shares immediately once they're purchased. And as long as the market price when they're sold is higher than whatever price with the discount you get off of them, which is, there's a very high likelihood that's going to happen in most programs, then you're going to come out ahead. And yeah, you owe some form of tax on that difference, but it's a convenient mechanism for people to use. You could also hold the shares, just like your restricted stock units, right? You defer money into your paycheck, you get a little bit of a discount on them. If you really believe in the company and the mission, then you hang on to them for a long time. The third mechanism are incentive stock options and non-qualified stock options. The taxation on these two things are a little bit different. Incentive stock options are more beneficial from a tax perspective, and if you hold them for a certain amount of time, you can have the entire thing taxed as a long-term capital gain, which is really beneficial. I'm not going to dive into the gory details there. But for most people who are granted non-qualified options or incentive stock options, you usually want to hang on to the options and just let the value of the company stock grow over time. And if your company is sold or purchased or acquired or merged or something like that, that's usually an event where all your options become exercisable immediately, even if they haven't vested yet. So those are the primary mechanisms. Now, alongside this, most people have access to a company 401k plan that you can defer more of your paycheck into on a tax-deferred basis, which is great. So the issue that a lot of employees who get these different forms of compensations at work, the issue that they run into is they become over-concentrated in their company shares because they have options, restricted stock units, and or employee stock purchase plan shares. And they have tax issues because maybe they make a lot of money. They have a lot of embedded gains in the shares that they hold, and diversifying out of them would create this big taxable event that we're trying to avoid. Plus, if you're making a lot of money in the tech industry, you're probably in a pretty high tax bracket to begin with, which is something you might want to minimize. So here's the strategy. If you have a 401k plan, any traditional salary deferrals you put into the plan are not going to be taxed from an income tax standpoint, federal or state. That's beneficial. The idea here is that you max out your contributions to these tax-advantaged plans, both the 401k and the employee stock purchase plan. And then as the restricted shares vest, sell them immediately and use that cash to pay your living expenses instead of the ordinary cash out of your paycheck every other week or every month or whatever the pay cycle looks like. So here's the difference. The ordinary way that we might think of this is, I put a little bit into the 401k plan, I put a little bit into the employee stock purchase plan, and then I have these RSUs that vest every now and then, and I just kind of hang on to them. And then whatever cash is left over from the paycheck, that's what we use to pay the mortgage, pay the bills, save for the kids' college, add to our emergency fund, whatever it might be. What I'm suggesting is the exact opposite of that. So you defer the maximum amount you possibly can into the 401k plan, which reduces the amount of your paycheck. And the reason you do that is because the more you put into the 401k, the less you pay in tax. You max out the amount you put into the employee stock purchase plan because you get that nice discount. And so the result of by doing that is you're reducing your tax burden every single paycheck that you defer a greater portion into these two plans. So that's the benefit. The drawback, of course, is that you have less cash deposited into your bank account that you have to play around with and pay the bills each month. And so on the surface, it sounds like a pretty, unpalatable option. Why would we ever want to do this? And the reason is because if you have these restricted shares that vest maybe every 6 months, and you also have shares from an employee stock purchase plan that are being purchased every 6 months, well, that's the value that you want to liquidate to use the cash for your personal expenses. It's a more tax efficient way to structure it all. And the drawback really is that you have to think about your cash flow over a longer term cycle. If you have restricted shares and employee stock purchase plan shares being bought on 6-month intervals, you're only adding to your cash balance every 6 months versus every time you receive a paycheck. But it's more efficient from a tax perspective, and you're continually keeping your exposure to company stock in check. I say this because we're running into a lot of people at the firm who work at tech companies and have done the former. We pay our bills from the cash that we get from our paychecks. We're participating in the 401k plan. We have these restricted shares. We're putting a little bit into the employee stock purchase plan. But I'm getting a little concerned that all of our wealth is tied up in company shares. But I don't want to sell the shares either because we have these large gains, and I don't want to pay tax on them. And that's a real problem. This way, by selling the restricted stock units right after they vest, remember, when these things vest, it's income to you whether you like it or not. But by selling them right off the bat, you're adding to your cash that you can use over the next 6 months to pay some of those expenses, and you're keeping your exposure to company stock in check by selling it before it has any of these gains that would result in a tax issue. So it's a somewhat aggressive strategy. It kind of reverses the flow of things. I'll say it again just to make sure that I've explained it adequately. rather than taking the paycheck that you get every other week, depositing it in the bank, and then having enough cash in the bank to pay your mortgage and your other expenses, what I'm suggesting is you reduce the amount of your biweekly or monthly paycheck by maxing out your deferrals to the employee stock purchase plan and the 401k. And it might make your paycheck look pretty small. And so if you do that, then you liquidate the restricted stock units every 6 months. You liquidate the employee stock purchase plan units. You sell those, and that's the cash that sits in the bank to pay your living expenses. So it really is a more efficient way to structure the thing if you think about it. And the beauty is that if you're in this situation, you probably have non-qualified or incentive stock options on top of this. It's not like you're not going to take advantage of future growth of the company if the company's acquired by someone else and the holders of the shares get paid out handsomely. You're still participating in that opportunity by holding the options. But at some point, you want to transition from that accumulation of assets to the preservation of assets, and that point is different for everybody. But there comes a time when it's really dangerous from a personal and a family perspective to be too exposed to the performance of the company where you work, because at the end of the day, if your company's not around, a lot of your holdings are going to go to zero, and you're out of a paycheck. And separating those two things at some point as you progress in your career and get a little bit older and maybe have a little bit more, family responsibility, which tends to happen as we get older, becomes more important. Okay, that's about what I had for this week. This is a topic that's been on my mind for a little while because we have clients who are going through these exact issues, and this is just a tax-efficient way to structure it. And I think step one would be just get in the habit of liquidating your RSUs and your ESPPs as soon as they hit your account, as they vest, as they're purchased, and then take the cash flow from there, figure out how much you can part with from a paycheck standpoint by boosting your contributions to the 401k, to that ESPP plan, whatever it might be. All right, that's it for this week. Thanks for listening, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.